The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.
Well, as we take a look at the market trade action midweek, we ended up with mixed activity. It was nice to see soybeans work their way off the session lows on Wednesday. Still some pressure in the wheat market, though. We got a lot of focus on the Federal Reserve meeting and the economy and more. We're also going to talk cattle inventory numbers. Joining us here today for a conversation while we are at the cattle convention in Orlando. He is at his home office in Kansas. Mike Zuzolo with Global Commodity Analytics joining us. Mike, good to talk to you, my friend, and a very busy day in the markets as we're ending the month of January on Wednesday, and we got that Federal Reserve meeting wrapping up after 2 days. Let's start there. What was the big takeaway you got from the Fed here this month, Mike?
Well, I think the big takeaway was we're done raising rates. And so the Fed's on the nest. They're not the hawk anymore. They're not going to raise rates anymore. The Fed chairman, in fact, said in quotes pretty much, we're in terms of policy rate, we're likely at its peak at this stage. And so the thing I think the market maybe got wrong, which I was kind of glad about in terms of the equity markets making new highs, new record highs in the United States here, Jesse, was the idea that they were going to cut rates as early as March. And that was probably, they had to pull back the reins on that based upon not just what the statement said, but also the beginning of the press conference with the Fed chairman, that they're not going to come in too early and mess things up, essentially. That may have spillover repercussions in terms of firming the dollar up a little bit, and that may give us some more pressure in the commodity sector, because the commodities typically like rate cuts. It usually generates liquidity. It usually takes the pressure off the emerging markets. And we need to take that pressure off the emerging markets, especially with what we've seen here in the last essentially full week in China between the data and the movement in their policy and their economic situation.
And I want to talk about that more in depth with you, as not only do we have the U.S. economy news here this week, but as you mentioned, China, there is a lot to take in there. I'll pull up our first chart on the video feed and talk to me a little bit more about what is going on in China right now and how that in turn is impacting our markets right now.
Well, I think this chart's really telling because it shows on the left-hand side the real GDP growth expectations by the IMF. When it comes to the actual World Economic Outlook, they just put out midweek this week, or on Tuesday, I guess it was. And this is, the left-hand side shows where they were back in October 2023 for 2024 growth, and the 2024 date there is where they're at now. And you notice the red area for China, they really bumped up China's growth for 2024. And the dot is where they were previously back in October. And so what that 2024 bar shows you is that the majority of the growth when it comes to the emerging markets is going to come from China, especially. And they bumped up those numbers by 0.4%. So China's growth now is at 4.6% on the new update from IMF. That means to me, and IMF said this in their commentary, that China is going to have to stimulate their economy to get 4.6% growth. And so when you think about this chart and you see what they're looking at in terms of stimulus, and then you see that they earlier in the week let the massive property group that's been holding them back and dragging them down, Evergrande, they let that fail and go into liquidation. I think they're addressing their problems adequately, and I think more liquidity will come from a standpoint of trying to shore up their consumer and try and shore up their property sector and their stock market, and that helping their consumers. So I think that's a big deal, but it goes back to what we talked about last week. It's really an important time period. These next 2 to 3 weeks are exceptionally important to put a China low in this market.
You and I take a look at the Bloomberg Grain Commodity Index quite a bit. You have another chart here comparing this with the Hang Seng Equity Index. So, what are you seeing here? Some of the correlations on this chart right now, Mike?
Yeah, the big thing that I like to show people when I travel or when I talk on air with you and others is there is a real strong tie between the macro fundamentals, especially right now about China and their stock market, because their consumer is so involved in their stock market and so involved in their property market that the person getting hurt the worst is the person that's buying all the commodities and the pork, and that's the consumer over there. And so this relationship between the Bloomberg Grain Commodity Index and that Hang Seng market is at a positive 0.82. So you essentially have over an 18-week basis in those two prices a positive 82% relationship. And so why would the wheat and the crude oil come in and break this market back higher on good news when it comes to the Chinese market? Or why would the hogs and the soybeans both help lead the rallies when you get good news on the Chinese stock market or on the Chinese property market or things like that? And I think this chart helps visually show you this is why, because the market is really watching China, really watching the Hong Kong equity market, and they're probably not going to come back into grains in a real significant manner until they get the all clear out of China's stock market.
Well, in terms of corn and soybeans here, I want to talk a little bit more about price action and just some of the things you are seeing. And let's look at Gulf corn prices here for a minute. And you talk about, a China low here in the market. I'm very curious your thoughts here, just with all of this economic news that we're seeing. You throw in there the South American crop, China going to South America more. We're connecting the dots here, Mike, and some things are clicking for me here right now. So walk me through kind of this aspect of what you're seeing right now.
This chart, I think, reflects really well the fear in the market that if we don't get a China low right here, right now, and in 2013, heading into 2014, I think is a good analog time period to be watching for us coming out of 2023 and heading into 2024, that we had a very good market bump. I suspect that South America helped with that bump, but I would also suggest that we were coming off some of the negativity in China based upon that MIR 162 genetic and them really not wanting corn anymore because they were slowing down again. And we did get that China bump early in the year, and that was a good bump to sell because that then essentially was it for the next 5 years. And I think this is what the trade is most concerned about. Number one, we don't get a China bump and we go straight into the 2015, 2019 time period in terms of price action for the corn. And what I would say to you, Jesse, is that what I like about this chart so much is that we are still at $5 when it comes to the NOLA cash price. And we're actually still cheaper than Brazil when it comes to the port of Paranagua. And so that's a big difference between where we're at in corn versus beans. We're talking about being $2 more expensive in soybeans at our Gulf versus the port of Paranagua, and bringing soybeans into the Southeast this week by some reports at about $1.35 underneath the March futures. But this corn chart shows us that we've got a cash market that's still supporting us, and there's less need for us to go lower. So I think this is why I say this next 2 to 3 week time period is so critical. The month of February is critical between the WASDE report, the base price for crop insurance for corn and beans, and China. These things just can't be underestimated and overlooked. And so if you don't do anything else in the month of February, now that we've closed out January, elevate your marketing plan, because this is a crucial time period.
Let's look at the monthly corn continuation chart as well, just to kind of add in with our discussion. Anything you are seeing here on these corn charts as well? Any other indications we need to keep an eye on, Mike?
Yeah, we're going to close with a multi-month, multi-year low close when it comes to the corn market, even though the weekly chart is giving a buy signal. This monthly chart after Wednesday's end of the month trade just looks really, really tough. The only good thing you can say about it is that we're extremely oversold in those stochastics where that blue arrow pointing down is. We're near the zero line when it comes to both the slow and the fast stochastics. And so that would suggest to me it would not take much for the market to create a short covering wave. And that goes back to where the funds are at over 270,000 net short contracts right now. So I highlighted here again the 2015 time period through 2020, just to give you an idea of what the corn price did. I think we had an average price of around 360 in 2015 for corn. So that early April, May top in the 2014 corn market was certainly something that, looking back on, was a great place to hedge. And that's kind of the model type mindset I have. Last thing I'll throw out is I did cut my value levels by 15 cents since this last WASDE report. However, I still think we're underneath the cheapest value for corn from a world supply demand mindset, because I still think that Brazil's got issues, and they're issues that neither Argentina nor any other country can really help offset at this stage. Another big difference between beans and corn: bean bulls out there are being fought and beat up against the bean bears, saying, look, we did 195 in terms of bean production last year. When it came to Brazil, Argentina, Paraguay, we're probably going to do 215 to 220 this year because Argentina and Paraguay are going to pick up the slack. I don't see that as much in the corn side.
We are talking today with Mike Zuzolo from Global Commodity Analytics. Mike, I want to make sure we have time for cattle here, but I also want to look at the soy market too. Soybeans had a nice rally off the lows on the day Wednesday. Talk to me about that and some of the world prices you're watching right now.
Yeah, this world chart really is all telling. I mean, as I said a minute ago, we're talking about, $60, almost $70 a ton being more expensive. That's $2, roughly $2 a bushel more expensive at the Gulf of Mexico. And I think more importantly, Jesse, is, as we've talked about before, if we've got damage in Brazil, or if we continue to have weather issues in certain parts of the country of either Brazil or Argentina, you've got to think at some point these prices are going to start spiking, and these actual cash physical prices will start working into the chart price action, and we'll start to see a change in the trend. And so I don't see our prices bottoming at the Gulf of Mexico for soybeans until Brazil's prices start to come up or Argentina's prices start to come up. So I'm still a hedger in the soybeans. I put on puts, recommended puts this week for clients and subscribers when we took out those January crop report lows on a closing basis. I'm sure glad I did the puts, because I thought to myself in hindsight, I'm glad I didn't do cash sales from a standpoint of the reaction of the market going back up with this China news being more positive in some respects. But what if I had not gotten that China news from the IMF? What would have happened in terms of downside potential? So I think having a floor underneath you in the beans is a really good idea.
All right, let's talk cattle. Cattle inventory report out Wednesday afternoon, Mike. January 1 cattle inventory down 2%, 87.2 million head. That was below the 88.8 million head January 1 of last year. Just looking at these numbers, calf crop down 2% as well. Overall, I guess instant reactions to these numbers, Mike, feels fairly neutral to even friendly. What do you think?
I think so too, Jesse, because you said it. I'm looking at that report for 2023, January 1. It says 88.84, but I'm looking at the January 31st, 23 report, and it says 89.3. So they brought the inventory down even more for 2023. So the 2024 number does not look as tight, and the supply didn't fall as much, but it really did when you look at it from a perspective of what the trade was dealing with before these numbers came out. So that 87.2 number that we got today for January 1, that's actually down more than 2%. 87.5 would have been a 2% cut. So I think it is a slightly favorable report. I do think, though, however, with the warmer temperatures coming in and the Packers back in the red and Lent coming, I'm not sure it was enough to feed the bull. So my suspicion is if we don't get an immediate market reaction and take this market on up, with a pretty good sizable clip from buying of the funds, I'll probably start getting to the hedge game again, because we are hitting those price levels that are above the USDA average prices for Q2 in the fat cattle market already.
Good thoughts there. We do have one more chart I want to take a look at. It's a monthly feeder cattle continuation chart. And, feeders have kind of been the leader here the last few weeks, I would say. So wondering, depending on how the market digests this cattle inventory news, what could that maybe mean for this feeder market, Mike? I guess talk about that and what you're seeing on this chart right now.
Yeah, three things. The calf prices have been red hot. I mean, you're talking about $300 calf prices plus, and I mean that's some cases a low number. Oklahoma City was $10 to $20 higher this week. So the grazing, the pasture in the Southern Plains, the winter wheat crop, that's bringing back the calf market. That's why the feeders are supercharged compared to the fats, in my opinion, Jesse. So I do think the feeders are more likely to make the top first, because they're the ones that have been going so hard. And the buyers will probably run out first in the feeder cattle market. So second point is, I think we're still very close in similarity to the 2014, 2015 model year. We had a big pullback in late 2014. Heading into 2015, we made a low. We went higher into March. We're able to recover, $12, $13 of premium pretty easily, and then try and stretch our legs until we got to April, May, and then we fell apart again in May of 2015, roughly speaking. And I think that's a good model year to keep in mind for the feeders and also for the fats here this time around, especially if that dollar doesn't break back down in price action. I think the third thing would be going back to the corn market and the feeders and the funds. If the corn market's trying to make a low and we do have a turnaround in the corn, how will the funds handle that? Because they've been such big participants in buying feeders and selling corn once again on that spread here in the last 2-3 weeks.
Mike, awesome stuff. We packed a lot here into a short amount of time today. Let's wrap it up, put a bow on it. What do you want folks to remember here as we're rounding out the month of January and looking ahead to February, Mike?
Think about that grain index against the Hong Kong market. I really think most of the roads lead back to China. If we're forming a very hard low here and we're going to get a China bump, I think it really does have to start with the Chinese equity market and the Chinese currency. And if I don't see that in the next couple of weeks, I'll get really, really defensive.
Fantastic. If folks want to reach out to you for some advice or look at your analysis, how can they get a hold of you, Mike?
GlobalCommResearch.com, and it's GlobalComm with 2 M's, research.com. Lots on there to look at, including product services and a free trial offer.
Fantastic. GlobalComm with 2 M's, research.com. With that, Mike Zuzolo, Global Commodity Analytics. Thanks for joining us. Appreciate it as always. We'll talk to you next week.
Thanks, Jesse. And tell the cattlemen and women down there hello.
I will do just that. Mike Zuzolo joining us here today on Market Talk. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.
If you miss an episode of Market Talk, you can listen back to the show anytime. Just search for Market Talk on your podcast platform of choice, and you can hear past episodes of the program on demand.